The Federal Reserve. Sounds like a place where they keep extra flags, right? Or maybe a secret government warehouse filled with mysterious artifacts? Nope. It's actually way more powerful and influential than you might think. Think of it as America's money manager, like that one friend who's weirdly good with their finances and always knows where every penny goes. They don't carry cash, they manage liquidity, ensuring there's enough money flowing through the economy. The Fed is basically that friend, but for the entire United States economy, making sure everything runs smoothly. We're talking interest rates, bank loans, and all that fun stuff that keeps the financial world turning. And just like your friend who stresses about credit card debt, the Fed gets really anxious about inflation, which is when prices rise too quickly. Too much money floating around, prices go up. This can make everyday items more expensive. Not enough money, the economy stalls, businesses close, and people lose jobs. It's a delicate balancing act, my friends, requiring constant adjustments and fine-tuning. The Fed tries to keep things stable so we don't end up like that time your friend convinced you to invest in their guaranteed cryptocurrency scheme. Spoiler alert, it wasn't guaranteed. And that's why the Fed's role is so crucial. And just like that friend who always seems to have multiple side hustles, the Fed wears a lot of hats, managing various aspects of the economy. It's a bank for other banks, providing them with the support they need to operate smoothly. It's also a lender of last resort, stepping in during financial emergencies to keep the system afloat, and the guardian of our financial system, ensuring its stability and integrity. Sounds like a lot of responsibility, right? Well, it is. And the Fed takes it very seriously. The Federal Reserve plays a vital role in maintaining the health of our economy, making sure everything stays on track. Before 1913, the United States financial system was basically the Wild West. There were no rules, no regulations, and certainly no safety nets. Banks did whatever they wanted, whenever they wanted. They could lend money recklessly, speculate wildly, and there was no one to stop them. It was like a financial free-for-all, and let's just say, it wasn't pretty. The lack of oversight led to rampant corruption and instability, panics and crashes. Oh yeah, those happened all the time. People would lose their life savings overnight, and there was nothing they could do about it. Remember the panic of 1907? No? Well, it was a real hoot. Banks failed left and right, and the entire economy was on the brink of collapse. The infamous bank tycoon, J.P. Morgan, had to step in and save the entire financial system from his living room. He organized a group of bankers to provide emergency funds. Not exactly a sustainable model, right? Relying on one man to save the day was a risky and unreliable strategy. Something had to change. Enter the Federal Reserve Act of 1913, signed into law by President Woodrow Wilson. This act aimed to bring order to the chaos. It was like the sheriff finally rode into town, except instead of a six-shooter, they brought a bunch of economists and a complicated system for managing the money supply. The Federal Reserve was established to oversee and stabilize the banking system. The goal? To create stability, promote economic growth, and prevent another financial meltdown. The Federal Reserve would act as a central bank, providing a safety net for the economy. It wasn't perfect, but hey, at least we weren't relying on J.P. Morgan's bathrobe and slippers anymore. The Federal Reserve brought a new era of financial oversight and stability. The Fed has had its fair share of triumphs and, let's just say, learning experiences. From its inception, the Federal Reserve has been at the heart of America's financial system, navigating through both calm and stormy waters. The Great Depression? Yeah, that was a tough one. The economic collapse left millions jobless and hungry, and the Fed's actions, or lack thereof, have been scrutinized ever since. Some argue the Fed could have done more to prevent the worst of it. Critics say that with more aggressive intervention, the economic downturn might have been less severe. On the flip side, the Fed played a crucial role in stabilizing the economy during the 2008 financial crisis. By injecting liquidity and lowering interest rates, it helped prevent a complete financial meltdown. Remember that time your friend with the guaranteed cryptocurrency scheme came begging for a loan? The financial landscape is always evolving, and the Fed has to keep up. The Fed is like the friend who actually gave out loans, with interest of course, to keep the whole system from collapsing. It acts as a lender of last resort, ensuring that banks can continue to operate even in tough times. The point is, the Fed's track record is a mixed bag. There have been successes and failures, but each event has provided valuable lessons. It's not perfect, but then again, neither are we. The Fed, like all of us, is constantly learning and adapting. The important thing is that the Fed learns from its mistakes and evolves with the times. By analyzing past errors, it aims to make better decisions in the future. Because let's face it, the world of finance is about as predictable as a toddler on a sugar rush. The Fed's ability to adapt is crucial in navigating this ever-changing landscape. So, we've established that the Fed is important, but what does it actually do? Contrary to popular belief, it doesn't just print money willy-nilly in a secret underground bunker, although that would be pretty cool. One of the Fed's main gigs is setting interest rates. You know, those pesky little numbers that determine how much you pay for a mortgage or a car loan. The Fed doesn't set those rates directly, but it influences them like a puppet master pulling strings. Lower interest rates mean cheaper borrowing, which usually stimulates the economy. Higher rates, the opposite. It's all about finding that sweet spot between growth and inflation. The Fed also supervises banks, making sure they're not doing anything shady with our money. Think of them as the financial hall monitor, keeping everyone in line. So we did a mad dash on the Fed, its history, and why it is essential to the economy. So remember, the next time you're seeing rates rise or there's going to be a speech from someone called the Fed chairman, to tune in. Now that you know a little more, you may be able to understand how any changes in the financial landscape may affect you. If you found this video helpful, be sure to like, subscribe, and stay tuned for more videos with no-frill financial knowledge on the WealthWise Network.